The bank approved Marcus for a $400,000 mortgage on a Tuesday afternoon, and by Thursday, he had already done the math 3 different ways trying to figure out how he was supposed to eat. His monthly payment came out to $2,300. His take-home pay was $7,800. That is exactly 29.5% of his income going straight to a house he had not even moved into yet. 1.5 points above the rule every financial advisor quotes like scripture, and Marcus was one of the lucky ones. He got approved. The 28% rule has been the industry standard since the 1970s. It was designed when a median American home cost around $30,000 and a median household income was around $10,000 a year. That is a price-to-income ratio of 3 to 1. Today, the median home price in the United States is hovering around $420,000, and the median household income is around $78,000. That is a ratio of more than 5 to 1. The rule did not change. The world did. So here's the first thing you need to understand. The 28% rule was never a financial truth. It was a social contract written for an economy that no longer exists. And if you are playing by those rules in 2026, you are not being responsible. You are being obedient to a system that was not designed for the market you are actually living in. This video is about what Marcus eventually figured out, and it is about what most homeowners will never figure out because nobody talks about this in plain English. Stay with me, because in about 2 minutes I'm going to show you exactly why the math behind the traditional mortgage model almost guarantees financial stagnation, and what the mechanism is that breaks that ceiling without requiring you to sell your house or earn $150,000 a year. First, let's talk about what the 28% trap actually does to you over time. When Marcus signed his mortgage, he was not just agreeing to pay $2,300 a month. He was agreeing to a structure where his largest monthly expense was fixed, meaning it could not grow with his income, but it also could not shrink if his life changed. His raises went to groceries, gas, and the credit card he used when those two ran out. The Federal Reserve's 2023 survey of consumer finances found that the median American family holds less than $8,000 in liquid savings. Marcus was not unusual. He was the median. Here is where the trap closes. Housing costs do not just include your mortgage payment. Bankrate and the National Association of Realtors both estimate that homeowners spend between 1 and 4% of their home's value annually on maintenance, repairs, property taxes, and insurance. On a $400,000 home, that is $4,000 to $16,000 a year in costs that never build equity. That money disappears. Every year. Forever. So Marcus is spending $27,600 a year on his mortgage. He is spending somewhere between $4,000 and $12,000 more on the costs around the home. And he is building equity, yes, but mostly on paper and mostly in the interest-heavy early years when the bank is taking the lion's share of every payment. In year 1, a 30-year mortgage at a 7% rate. Roughly 80% of every payment is interest. Marcus is not buying a home. He is renting money from the bank and slowly, very slowly, getting credit for the walls. Here is the gut punch behind that number. If Marcus had taken that $2,300 monthly payment and invested it instead into an S&P 500 index fund averaging the historical return of roughly 10% annually, in 30 years he would have approximately $5.2 million. His house, appreciating at a national average of roughly 4% per year, would be worth about $1.3 million. The gap between those two outcomes is almost $4 million. That is not a knock on homeownership. That is a scale check. Shelter is the most expensive thing you will ever buy, and most people treat the purchase like a finish line when it is actually a starting gun for a cost structure that will follow them for decades. Now, I want to be clear. That comparison is not meant to tell you not to buy a home. It is meant to show you that a home, on its own, is a liability wearing the mask of an asset. Robert Kiyosaki said that in Rich Dad, Poor Dad, and got roasted for it, but the Federal Reserve's own data backs him up. The primary residence does not generate income. It absorbs it. So what do the people who actually win do differently? This is where we get to the multiplier habit strategy. And this is the part Marcus eventually found his way to 3 years late, but not too late. The core insight is this. If your primary residence is a liability, the only rational financial move is to use the equity and cash flow of assets to service that liability, not your labor income, not your raises. Assets, things that generate money while you sleep. Let me give you the model in plain spoken math. Say Marcus buys a rental property, not a second home, an income-generating unit, a two-bedroom condo in a secondary market. Think Tulsa, Memphis, or Columbus, where you can still find cash-flowing properties in the $150,000 to $200,000 range. He puts 20% down, which is $30,000 to $40,000. His mortgage on that property runs about $900 to $1,100 a month. Rents in those markets for comparable units are averaging $1,400 to $1,700 a month. After vacancy, maintenance reserves, and property management, Marcus is netting somewhere between $200 and $400 per month. That is $2,400 to $4,800 per year. Not impressive on its own, but here is where the multiplication starts. That cash flow is not Marcus's reward. That cash flow is the seed. Marcus takes that monthly net and puts it into a high-yield savings account or a short-duration bond ladder earning 5%. He does not spend it. He stacks it. In 3 years, he has accumulated enough for a second down payment, or enough to pay down a meaningful chunk of his primary mortgage principal, which triggers a recast that lowers his monthly payment without refinancing. Meanwhile, his rental property has appreciated. At 4% annually, his $175,000 condo is now worth approximately $197,000. His equity has grown not just from appreciation, but from principal paydown on the rental loan. He now has a second lever, a cash-out refinance on an investment property that recycles capital into a third asset. This is the multiplier, not a stock tip, not a business idea, a structure where each asset partially services the next and the primary residence. The liability gradually gets absorbed by the portfolio rather than the paycheck. The reason most homeowners never get here is not laziness. It is sequence. They buy the primary home. They absorb the full mortgage payment from their W-2 income, and they have nothing left to seed the first investment. The 28% rule, taken literally, ensures that your largest expense always comes out of your labor first. The multiplier habit strategy inverts that sequence. You build income-generating assets before, during, or alongside the primary home purchase, so that the labor income is partially freed up from the start. Let me give you the real numbers on what that difference looks like over 20 years. Person A buys a $400,000 home at age 30, puts 20% down, pays $2,300 a month from their salary, never acquires investment property, and retires at 60 with a paid-off home worth roughly $880,000 and whatever they manage to save in a 401k. Person B does the same primary home purchase, but spends the 3 years before building one rental unit in a secondary market. By the time they buy the primary home, that rental is generating $300 per month net. Over 20 years, they acquire 2 more units using the recycled cash flow and equity model. At 60, Person B has a paid-off primary home worth the same $880,000, but they also have 3 rental properties collectively worth around $700,000, generating approximately $1,500 per month in combined net income. Person B's net worth is roughly double, and they are receiving monthly income in retirement that Person A is not. The difference is not income. Both people earn similar salaries. The difference is sequencing and structure. Now here's where it gets uncomfortable, because this is the part most YouTube channels skip. The multiplier habit strategy has a real barrier to entry. Getting the first rental property requires capital, and capital is exactly what the 28% trap is designed to absorb. This is not a conspiracy. It is a system. Mortgage lenders are not evil. They are incentivized to maximize the loan-to-income ratio, which means they will approve you for as much as you can theoretically afford, not as much as leaves you with financial flexibility. The approval ceiling and the financial wisdom ceiling are 2 completely different numbers, and the bank has zero interest in telling you that. A 2022 paper published through the National Bureau of Economic Research found that households who purchase homes at the upper limit of their approved debt-to-income ratio were significantly more likely to report financial stress, carry revolving credit card debt, and have insufficient retirement savings compared to households who purchase below that ceiling. The bank approved them. The bank did not protect them. So what does Marcus do if he is already at 29% and has no seed capital for an investment property? The answer is not to wait for more income. Peer research data consistently shows that real wage growth for median earners has averaged less than 1% annually after inflation over the past 2 decades. Waiting for a raise big enough to matter is a losing strategy. The answer is to compress the timeline on capital accumulation by treating one fixed expense in the budget as an investment target instead of a lifestyle cost. Marcus cuts one category, not forever. For 18 months, he drives a paid-off car instead of leasing the new one. He stops the $200 monthly dining out habit and replaces it with $50. He pauses the streaming subscriptions, the gym he visits twice a month, and the weekend trips that feel necessary but are not. This is not poverty. This is a controlled sprint. In 18 months, Marcus has accumulated roughly $6,000 in additional capital on top of whatever he was already saving, combined with a modest home equity line of credit on his primary residence, which now has meaningful equity after 3 years of payments. He has enough for a down payment on a $150,000 condo in a cash-flowing secondary market. The sprint ends. The multiplier begins. Here is the final reframe, and I want you to sit with this for a second. When Marcus first got that mortgage approval, he thought the 28% rule was a ceiling, something he had barely squeaked under. What he did not understand is that it was a floor, a minimum baseline of financial extraction that the system requires before it lets you in the door. Nobody told him that the game does not stop at approval. It accelerates, and the players who win are not the ones who earn more. They are the ones who restructure faster. Most people spend their working lives trying to grow income fast enough to outrun their housing costs. The multiplier habit strategy is a different proposition entirely. It says that the primary residence is a fixed liability and should be treated like one, and that the only durable answer to a fixed liability is a growing asset base that eventually absorbs the cost. You do not beat the 28% trap by earning your way out of it. You beat it by building something outside it that makes the percentage irrelevant. Marcus figured that out at 33. You now know it today. If this framing shifted something for you, subscribe, because this channel exists for exactly the person who just felt that shift.